Hi everyone, Rob from Newfound Wealth Advisors. Welcome back to the next video in this series. Today we're going to be talking about mortgages. The most common mortgage is going to be a 5-year fixed rate. So it will have a fixed term, it will have a fixed payment, and then at the end of the 5 years, you would normally go back to the lender and you would renegotiate whatever the new rate is. And inside of the 5-year rate, you would normally have a 25-year or a 30-year amortization. That is what essentially keeps the payments low. Always remember though, that when you go back in after 5 years, you always want to make sure that your amortization has decreased by the length of the term. There's 3 primary options available for mortgages in Canada. The first one is the 5-year fixed, which we've discussed at length. The second is the variable, which essentially the variable can sometimes offer a little bit more of a competitive rate, but the issue is that it will fluctuate with the prime rate or the Bank of Canada rate. So if the Bank of Canada rate increases, you would pay more. If the Bank of Canada rate reduces, you would pay less. The other one is what's called a home equity line of credit. So the key differentiator between that and a traditional mortgage is, in a traditional mortgage, whether it's 5-year fixed or whether it's variable, is that the lender is charging you what's called compound interest. Inside of a home equity line of credit, you pay what's called simple interest. It has the most flexibility. Over the last 4 years, housing prices in the St. John's area have increased by about 40+%, which is unheard of in this area. If you have less than 20% to put down on a mortgage, normally you would go for a 5-year fixed mortgage. Outside of that, if you have, say, 4+ years inside of your home, especially depending on the market values that have increased in the St. John's area, you really need to look at some of the other options that are available through every lender in Canada. No, not really. There used to be a time when having physical locations was very important to people. Now, not so much. There are a lot of online lenders. There's a lot of we call them non-brick and mortar. Essentially, they don't have a physical location. A lot of those lenders do offer mortgages, and sometimes the rates, terms, and conditions can be quite favorable for people. Their bottom lines are normally a little bit better. I always encourage people to shop the market. Mortgage brokers are a great option as well, but there are a lot of options out there that normally, just because you don't see the sign everywhere, doesn't mean there isn't a better option available.